to show us you about the market update. The global economic barometer issued another warning. South Korea's exports grew negatively for 6 consecutive months. According to data released by South Korea's Ministry of Trade, Industry and Energy on Saturday, South Korea's trade deficit reached 4.62 billion US dollars in March, a deficit for 13 consecutive months. In addition, South Korea's export in March fell by 13.6% year-on-year, showing a negative growth for 6 consecutive months. Affected by the cooling of the global economy and the continued downturn in the semiconductor industry, South Korea's exports fell year-on-year for the 6 consecutive months in March. However, it is somewhat consoling that the decline in exports was not as large as expected. Specific data shows that export volume of Asia's fourth largest economy was $55.12 billion in March, a year-on-year decrease of 13.6%, and the expected decrease was 17.5%, while the decline in February was 7.5%, the longest drop ever. Imports fell 6.4% year-on-year to $59.75 billion in March. In the first quarter of this year, South Korea's export fell by 12.6% year-on-year. This is the worst data since the second quarter of 2020. It is a heavy blow to the economy that relies heavily on international trade. South Korea's export can be said to be a major barometer of global trade, giving people a preliminary understanding of global demand, because the country produces chips, displays, and refined oil, which are key products for multiple supply chains. The country is also home for some of the world's largest semiconductor and smartphone makers. In terms of export destinations, South Korea's export to China fell by 33.4% year-on-year in March, marking the 10th consecutive month of decline. South Korea's export to the United States increased by 1.6% year-on-year, while exports to Europe fell by 1.2% year-on-year. In terms of export categories, semiconductor exports plummeted by 34.5% year-on-year in March. This is the 8th consecutive month of decline, which seriously dragged down exports for the month. Exports of display fell by 14.6%, 41.6%, while automobiles rose 64.2% and petrochemicals fell 25.1%. With the deterioration of the global economy, South Korean experts have frequently sounded the alarm since the middle of last year. The impact of conflict between Russia and Ukraine and the interest rate hike of major central banks have hit global demand, resulting in continued weakness in South Korean exports. Meanwhile, the banking crisis followed by the collapse of SVB and the troubled Credit Suisse also hit consumer confidence, keeping demand tepid. It's probably a pretty dangerous time for the global economy right now, says Edward Prasad, a professor of trade policy and economics at Cornell University. Adding to the problems in the banking sector on the top of rising interest rates in advanced economies, he said, its impact could be felt globally. More broadly, the global trade and financial system is based on the dollar, which means the tighter financial conditions in the U.S., such as lower lending, higher borrowing cost, and the lower stock and other asset prices, could spread quickly to other economies. Global economic growth could slow by 1.6% this year if concerns about banking conditions persist longer, leading to tighter funding costs and funding conditions, with credit growth likely to stall, economists at Citigroup said. On Friday Eastern Time, FOMC Permanent Voting Committee and New York Fed Chairman Williams said they are closely monitoring the impact of recent banking crisis on the economic outlook and are also cautiously weighing on the extent of interest rate hikes. Regarding the outlook for inflation, Williams is more optimistic. He expects that inflation rate in the U.S. will drop to about 3.25% this year, and then move closer to the central bank's 2% target in the next 2 years. Earlier in the day, data released by U.S. Bureau of Economic Analysis shows that the Fed's favorite inflation indicator slowed more than expected. The U.S. PCE price index rose 0.3% month-on-month in February, in line with expectations. It rose 5% year-on-year, the lowest level since October 2021, lower than market expectations of 5.1% and the revised of 5.3% in January. In a speech in Bridgeport, Connecticut on Friday, Williams said the Fed has taken decisive action to reduce inflation, but there is a lag between policy action and its effects. All of our inflation containment measures it'll take time for inflation to fall back to the 2% target. Williams says the recent turmoil in the banking sector may have played a role in lowering inflation because it could limit credit to businesses. He believes that the economic outlook is full of uncertainties, and the turmoil in the banking industry may cause credit conditions to tighten, thereby affecting economic growth. He says the Fed will focus on the evolution of credit environment and the implications of that evolution for the outlook of economic growth, employment, and inflation. However, Williams emphasized that the U.S. banking crisis that broke out in March this year is very different from the 2008 financial crisis. Currently, U.S. banking system remains robust and resilient. Williams also said he expects economic growth to be moderate this year and accelerate next year, with the unemployment rate rising from 3.6% now. He said slower growth and tighter monetary policy will likely lead to some slack in the labor market. Therefore, I expect the unemployment rate to gradually rise to around 4.5% over the next year. Federal Reserve officials last year raised their benchmark interest rate by 25 basis points, continued their efforts to cool price pressures despite recent turmoils in the U.S. banking sector. Williams pointed out that the Fed's interest rate adjustment so far has mainly been to cancel the support provided to the economy during the recession. What we've done is mainly to get interest rate back to a more normal, somewhat restrictive level, he said in a question and answer session after his speech. On the same day, Fed Governor Tim Cook said that recent turmoil in the banking industry have a negative impact on economic growth this year, and further interest rates will depend on the strength of future data. If tighter credit conditions dampen the economy, the federal funds rate could be lower than previously thought. Boston Fed President Collins said in an interview with the media that the Fed still has more work to do in reducing inflation, and officials need to pay close attention to the data to assess how much the banking turmoil has affected the credit environment. That's all I have today. Thank you for listening. Don't forget to subscribe and like. See you next episode.